Is the only thing stopping you from retiring early your health insurance strategy or lack thereof? There's a game-changing strategy hidden inside the Affordable Care Act, ACA, that is your secret weapon in your early retirement dream. With a few smart moves, you can unlock affordable health care and walk away from work years sooner than you think. Sounds too good to be true? It's not. I'm about to show you exactly how it works in under 10 minutes. Because, it is insurance. I'll show you how to reduce your premiums and avoid the 5 costly mistakes that trip up so many people. Health insurance is the number one concern for most people retiring before Medicare kicks in at 65. The good news is the ACA offers subsidies that can keep your premiums low, but only if you know how to navigate the system. And unfortunately, many retirees get tripped up by the fine print. One misstep, and you could be on the hook for thousands in unexpected costs. Let's start with mistake number 1. Misunderstanding what counts as income. Here's where most people go wrong. They accidentally report too much income and disqualify themselves from subsidies. The ACA bases subsidies on something called modified adjusted gross income. But it's not just your paycheck that counts here. There are a lot of other income sources that are included that can sneak up on you if you're not careful. Those would be withdrawals from pre-tax retirement accounts like 401ks or IRAs, tax-exempt interests, untaxed portion of your Social Security benefits, and rental property income. The key here is to manage how your income shows up on paper so you don't inflate it by accident. A small mistake could push you out of the subsidy zone, forcing you to pay more for your insurance, and we want to avoid that. Mistake number 2, missing the income sweet spot. This is the part that can feel tricky, but stay with me because it's worth the effort. To qualify for ACA subsidies, your income needs to fall between 100 and 400% of the federal poverty level. In 2024, that means $15,060 to $60,240 for a one-person household, and $20,440 to $81,760 for a two-person household. So if you land in this range, congratulations, you're in the subsidy zone. That means you can unlock significant savings on premiums, but fall outside of it, even by a little, and your premiums could skyrocket. Here's a question for you. What's your biggest concern about managing health insurance in early retirement? Drop it in the comments. Here's your secret weapon to combat this. Look poor on paper without actually earning less. Here's where things can get really interesting. To stay in that subsidy zone, you need to control what shows up as income. And guess what? Not all money counts toward your modified AGI. Here's how to make that work in your favor. Withdraw from Roth IRAs. Those withdrawals are tax-free and don't count towards your AGI. Delay and minimize capital gains if you can to keep your income low, and spread rental income across multiple years to avoid sudden spikes. Max out your health savings account. It's triple tax advantage. Lowers your taxable income, and withdrawals don't count as income. These aren't just random tricks. They're how retirees look poor on paper to qualify for premium savings. You're not really poor, you're just playing the game the smart way. I created a video that goes more in depth on this poor on paper topic, and I'll link it here. Mistake number 3, underestimating income. While overestimating incomes keep people from getting subsidies, underestimating income can be just as costly. If your real income ends up higher than you reported, you'll have to pay back subsidies at tax time. And nobody likes surprises at tax time. To avoid this, estimate carefully and update your ACA application if your income changes during the year. This way, you won't be caught off guard by penalties or coverage gaps. Mistake number 4, choosing the wrong plan. Picking the wrong plan could leave you with gaps in coverage or sky-high out-of-pocket costs. Here's a quick breakdown of the ACA plans so you can choose wisely. Bronze plans, lowest premiums, but high deductibles. Great if you're healthy. Silver plans, moderate costs. If you qualify, these plans offer extra cost-sharing reductions too. Gold plans, higher premiums, but lower out-of-pocket costs. Ideal if you expect regular recurring doctor visits. And then platinum plans, the most expensive, but with the best coverage. Perfect for people with chronic medical needs. Choosing the right plan means finding that sweet spot between what you expect to need and what you can afford to pay. Mistake number 5, missing enrollment deadlines. Don't get caught without coverage. The ACA's open enrollment period runs from November 1 through December 15th. Miss that window and you'll be without coverage for an entire year, unless you qualify for a special enrollment period because of life events like moving to another state, getting divorced, or losing previous coverage. Here's a pro tip. If this all feels overwhelming, and it's okay, use a health insurance agent at no extra cost to you. Their fees are already baked into the premiums, so you might as well get expert help and avoid mistakes for free. The ultimate payoff here is you get to retire early, stay covered, and keep more cash in your pocket. By implementing a solid ACA strategy, you can retire well before 65 without stressing over health insurance draining your savings. The right moves here mean lower premiums, fewer worries, and more cash for the things that matter, like traveling, exploring hobbies, or spending time with the people you love. If this video gave you some clarity, check out my retirement planning playlist for more tips. With the right plan in place, retirement can truly be about freedom, living life on your terms without worrying if you can afford it. Until next time.